Welcome to the Deep Dive. We're digging into the Q4 2025 earnings call from the world's largest asset manager, which reported before the market opened on January 15th.
That's right. And our mission today is to get past the headline numbers.
Because the story here isn't just about scale, it's about a really fascinating strategic pivot.
Exactly. The market reaction alone tells you something bigger is going on. The stock jumped, almost 6% right at the open?
Right.
That's not just a good quarter reaction, that's a validation of a strategy. The real question we need to answer is how a company this big, managing over $14 trillion, finds a way to accelerate growth like a startup.
Okay, let's unpack this. Let's start with those hard numbers, because they were just, massive beats across the board.
They really were.
Let's start with earnings per share. Adjusted diluted EPS came in at $13.16. The consensus was way lower, around $12.21.
Yeah, that's a nearly 8% positive surprise on earnings, and the top line, the revenue, told the same story.
Came in at just over $7 billion.
$7.008 billion, to be exact, which beat the $6.69 billion consensus. And for you, the listener, the key here isn't just the beat, it's the why. That's almost a 5% beat on revenue, and it represents something like 23% year-over-year growth.
So they really captured the market rally in Q4.
They absolutely did. And that translated directly into flows and assets under management.
Which hit a new record. I mean, they ended 2025 with $14.04 trillion in AUM.
It's an almost incomprehensible number. You're basically talking about managing capital that's roughly the size of China's entire GDP.
And that scale is what lets them make these huge bets. But it was the flows that really showed the momentum.
Exactly. That's a proof of execution. The full year saw a record $698 billion in total net inflows.
And a huge piece of that, $342 billion, came in the last quarter alone.
That's the accelerating momentum that management just kept repeating on the call. The numbers back it up.
And they immediately signaled that confidence back to shareholders. Let's talk about the capital return.
Sure, two big things. First, a 10% dividend hike bumps the quarterly payout to $5.73 share.
That's a strong signal.
A very strong signal. And second, they're targeting $1.8 billion in share buybacks for 2026. This is after they already returned a record $5 billion to shareholders in 2025.
It's a clear message.
Mm-hmm.
The cash flow is durable, and it's accelerating.
Mm-hmm.
Okay, so that brings us from the numbers to the core growth engine. This is where the story shifts from just being about scale to something more like a high-margin utility.
You've hit it exactly. They are fundamentally trying to change the conversation from being just a leader in public market beta. They want to be the integrated operating system for your entire portfolio.
Here's where it gets really interesting. Let's talk about that organic growth momentum.
Okay.
2 straight quarters of double-digit organic base fee growth, 12% in Q4. Why is that 12% number so critical?
Because it's the cleanest metric you can look at. Organic base fee growth ignores the market's ups and downs and just focuses on what clients are actually doing, putting new money to work that generates fees.
So getting 12% growth at their size is unusual.
It's phenomenal. It shows their growth is becoming almost mandated by what clients need, not just what they're selling.
And it sets them up for 2026 with a base fee run rate that's about 13% higher than the year before.
Right. And that momentum is directly tied to this pivot into private markets and technology, which means integrating some huge recent acquisitions.
Let's name them. We're talking about Global Infrastructure Partners, or GIP.
Yep, for infrastructure. Then HPS, a huge player in private credit. And then Preqin, the data firm.
The critical data piece.
Absolutely. And management was very clear that 2026 is the first full year where all these pieces are operating as one integrated firm. It's a new model.
And they've set some staggering future targets. They're aiming to raise $400 billion in gross private markets fundraising through 2030.
It is a massive target, but the Q4 flows show it's already working. They culled in $12.7 billion into private markets just in the last quarter.
Bringing the full year total to what, $40 billion?
$40 billion, yeah. And that was led mostly by private credit and infrastructure. They're just leveraging their existing relationships to offer these more complex, higher grade solutions.
Let me just challenge that for a moment, though.
Yeah.
That $400 billion, it's incredibly ambitious.
Mm-hmm.
Isn't there a huge execution risk in trying to mash all these different cultures and asset classes together?
Oh, that's the core risk for sure. But their bet is that the technology, the unified platform, is the glue that holds it all together.
If we connect this to the bigger picture, it's less about just gathering assets and more about owning the infrastructure.
It's about becoming essential.
Okay, let's talk about that tech backbone then. Aladdin. They reported 16% organic annual contract value growth in their tech services. So it's growing fast.
What's fascinating here is how the role of Aladdin itself is changing. It started as a risk tool for, public stocks and bonds.
Right.
Now it's being positioned as the one indispensable platform you need to integrate public and private assets, especially on a fiduciary level.
And this is being driven by potential regulatory changes, right?
Right.
The idea that private assets might soon be allowed more broadly in 401k plans.
Exactly. If the Department of Labor opens that door, every single plan sponsor in the country has a new, very complex problem.
How do you value and manage the risk of these illiquid assets inside a daily retirement plan?
And that's the problem Aladdin, now powered with data from Preqin, is being built to solve. It becomes a mandated regulatory solution.
Which makes that Preqin acquisition look absolutely brilliant. But how do you actually build what they called the machine for the indexing of the private markets?
It's aggressive, but the goal is to create the standardized language. Right now, private market data is a mess. It's siloed. It's not uniform. The plan is to use Preqin's data to build the benchmarks, then use Aladdin's risk engine and the iShares indexing engine to basically authenticate and provide transparent risk metrics for these asset classes. They want to own the language of the private economy.
Okay, shifting gears. Let's talk macro. Management gave a really specific view on fixed income and interest rates.
Yeah, they were very explicit. They expect a steeper yield curve in 2026. The bet is that the Fed will cut rates, and all that cash sitting in high-yield money market funds will start looking for a new home.
And there is a ton of cash sitting on the sidelines. So where do they think it's going to go?
They expect investors to move out the curve.
Meaning out of short-term cash and into longer-term bonds.
Exactly. To lock in those higher stable yields before they disappear, they see this as a generational opportunity in high-quality, steady income. And the flows already show it. They had $80 billion into fixed income in Q4, and their iShares bond ETFs grew at an 18% organic rate for the year.
And this isn't just a U.S. story. They spent a lot of time on global growth, especially Asia.
Right, because Asia's capital markets are just growing faster than ours. They pointed to Japan, for example, where changes to their NISA accounts, their version of a 401k, are unlocking huge retail investment.
And wealth management in places like Hong Kong and Singapore.
But the most interesting example, I thought, was the Jio-BlackRock partnership in India.
It seems like a totally different model for them.
It is, and that's the point. The partnership raised $2 billion at launch, which was like 6 times the previous industry record in India. They're already serving over 1 million retail investors there with a digital-first model.
So they're building the infrastructure for developing markets, not just serving mature ones.
That's the long-term play.
Okay, one last area before we get to the trade idea, the insurance channel. This is maybe the highest value part of their business.
It's incredibly sticky money. They're already the largest manager for insurance general accounts with about $700 billion in AUM.
So what's the play there?
With HPS, their private credit arm, now fully integrated, they're working to transition about 10% of the existing public bond assets. We're talking an order of magnitude of $70 billion into private, high-grade mandates for those insurers.
Wait, so that's not new money. That's just migrating $70 billion of assets they already manage into a higher fee product.
That's why it's such a big deal. It's pure margin expansion. Insurers need these custom long-duration assets, and this is an incredibly high-value, sticky transition. Management said those deals should start pulling through in the second half of 2026.
So what does this all mean? We shift now to our outrageous but plausible trade idea. And just a reminder, this is not financial advice, but it's a way to synthesize everything we've talked about for you to consider.
The pitch is straightforward. A structural long position. The street is still too focused on just the ETF flow numbers.
On the scale.
On the scale, yes. The real story, the real upside is in the margin expansion. It's driven by that mandated risk technology and the shift in flows toward high-margin private assets. The operating system thesis is being seriously underestimated.
Okay, so what's Catalyst 1?
Catalyst 1 is regulatory.
Okay.
You bet on the eventual approval of private assets in 401k plans. The moment that happens and regulators demand enhanced risk authentication, the Aladdin Preqin platform goes from being a great software product to being mandatory industry middleware.
Indispensable, sticky, high margin.
Exactly, a required utility.
And Catalyst 2?
Catalyst 2 is just pure execution. You wager that the $70 billion insurance migration and the $400 billion private fundraising targets are achievable. That mix shift plus their expense discipline, they're targeting flat headcount in 26. pushes their fee-related earnings margins over 50% in the next 5 years.
And a 50+% FRE margin would justify a massive valuation premium over their peers. But what about the execution risk on the M&A? Did they address that?
They did. They're betting the tech platform is the cultural glue, but that's still a main risk. The bet is that the long-term infrastructure play wins out over any short-term integration pains.
So this deep dive really underscores a few massive tailwinds. Record AUM, record flows, that double-digit organic growth, and a clear roadmap into private credit, tech, and global expansion.
If we connect this to the bigger picture, it really raises a huge question. How quickly will the entire industry be forced to adopt standardized private market data and risk tools? And how much value goes to the company that basically owns the language for that transition?
It's the infrastructure play. And the value of infrastructure is that it becomes mandatory. For you to think about, what are the implications when private assets finally enter retail retirement portfolios on a fiduciary level? That need for validated risk analysis changes everything. Thanks for diving in with us.